Hello, chart watchers, and welcome to this Thursday, May 2nd, 2019 Market Watchers Live Show with your hosts, Tom Bowley and Aaron Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. All right, let's take a look at what's going on here in the market. You can see the Dow Jones Industrial Average currently down 212 points. It's been a pretty steep drop since the Fed announcement yesterday at 2 p.m. The S&P 500 down 19, the NASDAQ down 60, and the Russell 2000 down 8. 10-year Treasury yield on the move to the upside, up nearly 4 basis points, 2.55%. Volatility index is definitely on the rise. Again, this picked up at about 2 o'clock or a little after 2 o'clock Eastern yesterday when the Fed came out with their statement. We'll talk about that in just a minute. Real estate leading to the upside. At last check, that was the only group I saw that was in positive territory. Energy leading to the downside along with materials. Both of these sectors continue to lag badly the S&P 500, and they are accelerating to the downside today. Heavy construction really taking it on the chin today, down 20 points, which is close to 5%. I think it was just under 5% earlier. One of the big reasons, Fluor Corp, FLR, apparently has no floor. The stock down 24% so far today. One bright spot, we did get a nice breakout on MetLife. This is in the life insurance space. Financials with the rising treasury yields, we could look for some outperformance there, and this is one stock that looks pretty good to me, breaking above some sideways consolidations with its earnings report. Okay, Aaron, it's Thursday, got second day of May, and I tell you what, normally the first 3 to 5 days of a calendar month are pretty strong, but ever since the Fed came out yesterday, not holding true. We're seeing a lot of selling here over the past less than 24 hours.
Absolutely. And, I find it interesting. Yesterday I was looking at the VIX and at breadth, and they were really climactic on my charts. But the VIX was getting very high. So usually I look for, a little bump, a little rally after that. But no, not quite. So maybe another day or two. But yeah, the VIX is climbing.
Yeah. And, the Fed came out yesterday, and we talked about this during the show. One of the things I wanted to see is how the Fed reacted to the lower than expected inflation that we've been seeing in a lot of different reports. And what the bond market, I think, has been telling us is that inflation is not a concern, that deflation is more of a concern, and that the Fed should be thinking about cutting rates, not raising them. And if we recall back to the fourth quarter of last year, the bond market was sending the Fed a message back then. The Fed, remember, they were talking about multiple rate hikes in 2019, and yet you'd look at the 10-year Treasury yield that just continued dropping and dropping. And then finally, the Fed said, well, after the stock market took the time, the Fed came out and said, well, never mind those rate hikes. We were just kidding.
Yeah.
We may not even hike in 2019. I don't know what we were thinking before. So they kind of came around to what the bond market was saying. Yesterday, it was almost a little bit of a replay in that the Fed was just has been ignoring what's been going on with the economic reports. The bond market's telling us one thing, and the Fed yesterday said, well, this low inflation data is just transitory, meaning that, it's not permanent. We're gonna have some other inflationary reports coming up. And since they went against the bond market, you can see it's almost been, a little bit of a, trip back down memory lane from the fourth quarter of 2018. And I'm not suggesting that we're going to see what we saw then, but I do think equity traders are saying, you're not paying attention to what's going on here, and maybe losing a little faith in the Fed. I don't know. You have any thoughts?
Yeah. I agree with that. It's, it's funny how they can affect it with just a few words, the market and which way it's going to go. But, honestly, Tom, I know we've both been looking at it. The market, after it hit those all-time highs, was really weak. And, I think anything less than positive coming out of the Fed was going to be a problem. And, here we are.
No doubt about it. Well, we do have a special guest with us today, Bruce Fraser. Bruce, it is always a pleasure to have you on the show. We always have so much fun, but this market is not fun here over the last 24 hours. Did you have any thoughts on what the Fed said?
I think the Fed, by the way, hi, everybody, and Erin and Tom, it's so great to be here. It's been 2 months since I was last here, and I'm feeling it. Anyway, I do think that the Fed was trying to get some of their credibility back because they made such a dramatic swing at the end of the year that they just sort of went all in, all on the gas, and it really helped the market get back to the highs. And we're in a place now where I think the Fed feels like that they've done their part to sort of cobble the market back together. And now we're, the Fed is saying, we're going to be, like back to our old stance. But keep in mind, and I have a chart for this in a few minutes, but keep in mind that the Fed's raised rates 9 times. And this is really cumulatively a weight on the economy. And so the fact that we're range bound during this whole time that we've had these 9 rate increases is really not surprising. Yeah. And I think it just points to the idea that we're in a big trading range.
Yeah, I completely agree. Well, Bruce is going to be back with us here in about 15 minutes or so. So if you don't mind, Bruce, stick around. I know everybody wants to hear your latest on what you're looking at. So just kind of be patient. We're going to get back to you, okay?
Thank you. Great to be here.
All right, Erin, we got a lot to go over. So why don't we get into the schedule and the agenda today?
Absolutely. All right. Well, what's hot, what's not is tomorrow. Mary Ellen will be in for that. May seasonality. Tom's going to be talking about that on Tuesday. Brian Livingston will be coming in on Wednesday, and John Murphy is going to be here Thursday. So do not miss that one. Mark your calendars, May 9th. And then we have Christopher Brecher coming in on May 15th. And we'll talk a little bit more about him as it gets closer. Today's agenda, Bruce, as we introduced, will be doing the first half of the show after the news and headlines. 10 and 10, we have Sangamo Therapeutics, SGMO. And finally, we're going to finish off talking about the relative strength of the industrials. Go take our poll because we're going to answer it for you at the end of the show, and we'll want to know what your answer is. All right, Tom, technical news and headlines. Let's move it on.
All right. Well, we did have some economic reports out today. You can see, of course, it's Thursday, so initial jobless claims came in a little higher than expected. Q1 productivity, big number there, 3.6% versus 1.9%, while unit labor costs came in much lower than expected. So we're getting a lot more output for less hours or less a wage. And that's a good thing for the economy. March factory orders came in better than expected, 1.9% versus 1.5%. And when we take a look at what is going on in the bond market, you can see that the 10-year Treasury yield is jumping back up. Now, keep in mind, going into that report yesterday, and I'm going to bring up an intraday chart. Well, actually, yesterday when we got down, you can see intraday. We went down below that the second week back in April. We got down to 2.45% or just above that level, and then reversed. It was after the Fed meeting when they came out. They, pretty much discounted lowering rates. That's when we saw that reversal in the 10-year Treasury yield and a move back to the upside. So we're seeing a little bit of follow through to that. I think overall the downtrend remains. I think one of the more intriguing things to watch over the next couple of months, or at least until the next Fed meeting, is what the bond traders do and what the yield does here heading into the next Fed meeting, because you can see this is what I was referring to earlier. The bond market was sending the Fed a pretty significant message in the fourth quarter of 2018 that we needed to be thinking about lowering rates, not raising them. And remember, during this period, the Fed was still adamant that we were going to raise multiple times in 2019. And so there was definitely a disconnect between the bond market and what the Fed was thinking. Then the Fed came back and said, okay, forget about that. We're not going to raise rates. Maybe none in 2019 and maybe one in 2020. That was a far cry from what they were previously talking about. So is the bond market getting it right now, or is the Fed right? And I'm going to be watching the bond market. I've said many times, I think the bond market is much smarter than the stock market. And so I always tend to watch what's going on there to kind of get a clue. So something to at least keep in mind as we go forward. All right, earnings reports. There were a ton out. I'm not going to go through all of these, but these came out yesterday after the close. Go on, and you can see Square actually did beat, but I'll show you why. I don't hold these stocks into earnings. Square took it on the chin with after lowering their guidance for the next quarter. And then on the next slide, you'll see Thursday this morning, we had a number of additional companies come out with their earnings. Some good, some not so good. We had a mixture. no doubt about it. After the bell tonight, we've got Gilead. You can see, actually, one I'll be watching pretty closely too is Activision. That's a stock that's been under tremendous selling pressure, been consolidating. Can we get a reversal, a character change on the chart? ATVI had been a great performer up until, I don't know, a few months back. And so now we'll just have, or maybe 6 months back. Now we'll have to see whether or not things are getting turned around there. All right, let's pull up a few of these charts. And I'm going to start first with, why don't we start first with Qualcomm? Qualcomm did come in with some earnings that did beat expectations. And that chart, of course, we had been going up. And I don't like today's candle. We'll see how it finishes. But we had been up significantly earlier today. And it's leaving a long tail up above these prior highs. I just think maybe in the short term might be a little exhausted. So if the market continues to struggle, I would suspect Qualcomm maybe is going to pull back. I don't know exactly how far, whether it gets all the way back down here into the upper 70s. But if it did, that would be a much, much stronger reward to risk entry in my view. A couple of others I did want to bring up. MetLife. You can see MetLife here trying to, what is making the breakout above the last 6 month highs. You can see we had been struggling between 46 and a half on many, many occasions. We're now above that. And actually, this chart doesn't have the volume, so let me get that in here. And now let me get the year. So we are getting the volume coming in to support this move right here. Almost 5 million shares already today. We're not even the halfway point. So we could be on pace maybe for 9 or 10 million shares. You see, that would be a very strong day. But if there's one negative, we did hit a 52-week high at the intraday high earlier, and we're backing off of that. So I think there's some positives here. But if we don't get that breakout on the close, I think we could maybe come back down one more time, test that 20-day moving average, and then maybe we get a breakout. We do see a lot of rotation in the market, in bull markets. This is a group that you can see has not really participated. This has been a stock that hasn't participated much in this movement to the upside, not getting the breakout, still waiting to get that breakout over the September high. So, but overall, I think when you look back, we've moved up, sideways consolidation, nice breakout. Things are improving here for the stock. A couple of stocks, and I'm going to go into the relative charts. And I wanted to bring up a couple. For instance, WLL. This is Whiting. This was not on the list that I showed you. But I just want to show you, when you see a company like this, Whiting, that is underperforming its peers, and its peers have been so weak versus the S&P 500, when they come out with their earnings and they miss top line, miss bottom line, and guide lower, we shouldn't be too surprised. Here's another one that I picked up. I hadn't even looked at the chart yet. TTM Technologies. Another one that had been underperforming its peers. Had been doing okay. Its peers had been doing just kind of okay versus the S&P. But again, because we've got such a weak stock within the group, they missed top line, they missed bottom line, they lowered guidance, and there you go. A couple of other things quickly before we move into upgrades, downgrades. I did want to just show you the S&P 500. Actually, I think I have the article over here. Let me show you my article from this morning, because one thing I mentioned, I did not like yesterday's reversing candle, that reversing bearish engulfing candle. We had gapped up, and then the Fed came out with their announcement. You could see the selling that took place there. Off of it with a negative divergence, the PPO not really following suit on this move to the upside. I think that combined with overbought conditions, RSI, negative divergence, reversing candle, I just simply said I'm bullish, but this is a time where you want to be a little careful. I wouldn't be surprised if this leads to some more consolidation or even selling in the near term. And of course, if we pull up the live version, can we hold the 20-day moving average? Currently, we are beneath it. Volatility's picking up. I think we want to be careful here in the near term with the S&P 500 showing some of these warning signs. Okay, Erin, upgrades, downgrades, what you got for today?
All right, I got a couple head scratchers today, so this should be fun. All right, well, we're going to start with the upgrades. AMED was upgraded today. Amedisys. I have to say, I'm not liking this upgrade at all. I mean, come on now. You look at some of our particular indicators, and I don't see anything really good here. I've got a PMO sell signal that's coming in below the zero line. Look look at the OBV pretty much just dropping very quickly on that decline. So Scooter is now at its lowest reading of all from all this year. I really don't see this upgrade. They moved it from, and not to a neutral, they moved it from market perform to outperform. That looks like some pretty heavy declining tops line, trend line resistance. And I don't know. I don't see it. Arconic, this one I agree with for sure. Goldman moved it from a neutral to a buy. $21 target moved up to $26. The only thing I could say that might be a little concerning would be sort of the parabolic move that's coming out here. But, I just think it's a stock on fire. Look at the OBV is rising nicely. You've got the PMO rising nicely. We had twice that it was moving down and looked like it might get a sell signal, and it managed to reverse out of that, and second time. And the scooter is just taking off. So I agree with that particular upgrade. Clorox, I'm not really very thrilled with, but they went, Deutsche Bank moved it from a sell to a hold. Their target is 139. So they're looking for a breakdown below these December and January lows. Boy, if you're going to get that breakdown, I don't know that I'd be holding this. So neutral. So like I said, sell to a hold, target 139. Look at this. We've got the PMO sell signal. Scooter is falling to the basement. And yet this was upgraded today. Head scratcher. All right. Estee Lauder was downgraded today by 2 agencies. This one, I can see why they would do it, but given the action yesterday and the possible breakout, of course, it closed down in that rising trend channel. I think there are some problems under the surface here that they were seeing. Number one, for me, is the momentum. Look at what happened. We have this really nice rally going on to the upside, yet the PMO is declining. And we're seeing the tops on the OBV declining. That's a negative divergence. So we really did have some, warning that maybe we might want to not hold on to Estee Lauder. And now we have these 2 tops below the signal line. I think that the downgrade is warranted here. Scott's Company, B of A Merrill, downgraded from a neutral to an underperform. This one is my head scratcher. I really think that this stock is looking pretty good. Look at the nice move of the PMO, obviously on the big move to the upside here. We are pulling back about 1.5%. I think it would be great if we saw it come back down here to that $85 level, close that gap, and then start its move back up. I just don't see anything that negative here for a downgrade, but neutral to underperform as far as B of A Merrill is concerned. Oh, and they have an $83 target. So they're not looking for a huge decline here, but I don't know. Tesla was downgraded, and this one is sort of one of those, it's about times for me. I haven't liked Tesla for quite some time. The only thing, as we were going along in 2019, I can see where you had a declining wedge, and those are bullish patterns. So I can see some of the bullishness that was, apparent and pretty much you saw a lot of. You had the double bottom here. It looked like it was going to take off, but as soon as we started getting these negative crossovers of the EMAs, that's a problem. That would have been a signal to me that there was a big problem. And then, of course, back here, the 5,200-day negative crossover. So really, I've been bearish on Tesla for quite a while. I just don't see anything for the pullout. And right here, you can see the low right now at 230. That's a low for the year. I'm going to show you the weekly chart just so we can get a feel for what's going on here and how important that area of support was in 2018, that we are closed below that last week. And we are trying to get back above that 240 level, but weekly PMO is not looking good. I would be looking, honestly, for Tesla to come down to 180. I think it might test that support level there. I don't like it. All right, that concludes the upgrades, downgrades. There is your summary slide. Bruce, let's bring you on back because I know you have lots to talk about, and we are always very interested to hear our viewers do love it when you come on the show. Always great comments.
Well, I'm just happy to be here, and it's just a blast. So much fun. So we're going to go fishing today, and we're going to talk about my favorite thing to do, which is to campaign stocks. And I'm going to define that very quickly, but first I want to have a few minutes to just talk about kind of the current market situation. And so here, let's have a look at the yield curve. And I'm going to, if I can, get a highlighter. Yeah, that's good. So you can see this is basically just some Wyckoff voodoo on the yield curve that I did. And the decline that we had since the beginning of 2017 is really an attempt to express that the yield curve is flattening, which is a measure of tightening. And so the yield curve came down and it got right to this level. I wrote a blog on it. You can go back and look at this. I think I wrote a couple of them, but it went down and it touched the oversold line of this trend channel. And then at that time, we concluded that we were likely to see a rally, and a rally would be the yield curve steepening, which is actually a good thing for the stock market. And in fact, it has been good for the stock market. But this extreme decline here was the yield curve not only flattening, but going negative. And this is 10-year to 3-month. But what's really interesting is I uncoupled these two yields, which is here's the 10-year. And you can see that since September, October, that the yield has been dropping on the 10-year dramatically. It went from 3.25-ish down to under 250. And so this has been a really steep decline. So in fact, I contend that the powers that be, the Fed and Treasury and so on, has been really lowering rates since October, especially on the long end. But the reason for that is kind of interesting, because look at this 3-month T-bill chart. And you can see here that the 3-month T-bill has been just going up for really since the end of 2015 is when the Fed started raising short-term interest rates. They've raised interest rates 9 times. And this is a cumulative effect on the economy. And so the economy has continued to, come along. It's doing the best job it can. But I think that the effect of these rising short-term interest rates and the flattening of the yield curve has been a drag on the stock market and on the economy. So we know that since the beginning of 2018, that the stock market has really been in a big trading range. And so here, just changing gears, is a intraday point and figure. This chart actually I brought to Market Watchers 2 months ago. And so this is March 5th. And at that time, we could already see an accumulation forming. In this case, we're using the Dow Industrials, but we could look at any index and it looks very similar to this. And we always say in Wyckoff, especially with point and figure, is that a cause precedes an effect, and a cause is either an accumulation forming or reaccumulation or distribution. And in this case, we're looking at accumulation. Well, there was so much volatility into the end of the year on this huge decline that the volatility produced a rather large accumulation area in this particular case in the Dow Jones. And this is an intraday chart, 30-minute data, ATR scaling, and it gave us a box size or a scale of 62.53 Dow points. Well, look what it did. It counted up to, so we knew this actually early in January, we could see this completed accumulation. And it counted up to 26, round numbers 27,000, and look where we are. And on top of that, we threw over the top. Now this is really occurred in February. I'm going to show you a current chart, which is a little different, and then came back into the channel, which we drew we can draw these trend channels on vertical charts and on point and figure charts. Here, I just want to show you that here is the range that we've been in the market, range bound, buying climax, early 2018, automatic reaction, huge volatile decline, and which set the range. So notice how the buying climax, automatic reaction set the range. It traveled along the bottom of this channel into the upthrust area, and this is late September, October, and the fourth quarter was just a waterfall decline. Huge amount of price damage into this shakeout, and this is where we did our point and figure counting, which gave us the count up to the area that we're at, which is the resistance line back at the buying climax. Now, the S&P and the NASDAQ have worked a little higher than the industrials at this point. So I'm just using the industrials because that was my point and figure count work that I did for, on that prior chart. So here we are up against resistance, fulfilling a point and figure count on the intraday. And here's the point and figure count brought up to May 1st. So here, now this is a 60-minute chart, ATR scaling, same area that's been the accumulation area where this count was taken. And it counted up into this 26,000. Let's blow this up. So this took us into this 25,514, 26,432 area, slightly lower than the other count that we had. And that's always going to be a product of using intraday data and ATR scaling. But notice this, we threw over the top of the channel. At that point, look, we failed all the way back down to the bottom of the channel and have ridden along it up to the area that we're at, a slight throw over of the top price objective of the point and figure. And now here we are turning off of that, showing weakness, coming back below the channel, which is a point, I believe, of important vulnerability. Okay, so let's just do some intraday point and figure just because it's fun. And that is, here we're looking at the NASDAQ 100 5-minute data. Now, 5-minute data can give you a lot of data. It's a different theme than 5-minute vertical charts. And so we just want to get a sense for initially how far down this market could go. NASDAQ 100, we can see here that we have 30 columns, which changes quickly on intraday. But this gives us about a 4.5% decline off of the peak that we have right here at 78.47, takes us down to 75.67, 75.02 into this area, which really takes back, this is April 3rd, this rally that we've had, which produced this beautiful up trending channel. Attempt to get above the channel for a while, was overbought above there, and then just fails right back down to what we call the demand line. Rallied up again to the top of the channel, tested it twice, and now it's in the process of failing. But this count takes us takes back all of the rally back to the beginning of April, which the way the market's trading today, it appears that that's entirely likely and could happen quickly. Okay, and now this takes a little imagination, this chart, but we really try to focus on this with our students and attendees to our workshops, is the idea of visualizing changing structures. So the idea here is that we have 3 big up thrusts. Each one of them has a slightly higher high, and then consolidates, slightly higher high, consolidates, and then these are diminishing thrusts. And then finally we have a 4th thrust, which doesn't go to a new high. Now again, this is just 5-minute data, ATR scaling, so this is potentially a very short-term phenomenon. But we count this with point and figure. It takes the Dow down to 26,076 at this level right here. But notice that this takes us down to important prior support right here. which makes a lot of sense. So the point and figure says we're going to go down to this area. Well, let's say we do go down to this area, and then we attempt to rally up, go to a lower high. Well, now this whole structure potentially could become countable from a point and figure perspective, and we could have a much larger count that could come into play or come into force. And so this is something that we need to prepare for, is the idea that if we have a rally of poor quality after a decline down to this initial count, that it could produce a larger distributional type structure. So we will keep a close eye on that. And so now I want to introduce campaigning stocks, because here we are talking about intraday, but campaign trading, in my mind, is a very long-term orientation type of trading, which Wyckoff is very attuned to. It's very good in this space. I would say that by far the most Wyckofians are swing traders. Swing traders we think of as being trading opportunities that are 3 weeks to 3 months, maybe 6 months. But this is swing trading. Wyckoff is really good at this, but Wyckoff is also really good at trading these campaigns that can last years. And I really like doing this type of long-term campaigning. And the inspiration for this really goes back to my youth. And I'm going to make this a very short story, is that when I was a boy, I worked for my dad as a concessionaire at racetracks, horse racing. And I may have mentioned this in the past, but when we would go to different fairs, we would have different people that would work with us every year. And they were just wonderful people, really interesting. But I have to say, growing up at the fairs was a little like being in a Fellini movie. And so it was really interesting. Subject for another day. But one of the people that I really had a great time working with was actually a retired banker. And he really enjoyed coming and working for a few weeks at the racetracks. And it was a lot of fun. He was a lot of fun to work with and talk to. I learned a lot from him. But the story that really stuck with me was that he was a really devoted fisherman. But he was only interested in one kind of fishing, and that was trophy fishing for bass. And so he would spend his time with me describing all of the detail and all of the strategy that he employed to identify and catch trophy bass and these absolutely magnificent, very large fish. And he loved to catch them, and I think that he always threw them back. But he just was obsessed with this. He loved it. And he went into how the kind of bait, how he baited the hook, where he went. And there was tremendous detail, as you would expect from a banker. And my understanding was he was an exceptionally good banker. And so that story really stuck with me. And I realized that if you organize your life to get what you intend to go after, that you can continue to just refine and create mastery at being able to identify and achieve what you want. And so I became very interested years ago in campaign trading stocks that could go up for years and years. And I realized early on that Wyckoff was really good at this. So I developed my tools, as my banker fisherman friend did, to identify and catch these big, beautiful fish, that I could do the same thing with campaign trading stocks. And the thing that he really impressed upon me was that he would go out fishing all the time. And his expectation was, because of the way that he set up his equipment, that he would only catch a fish occasionally. And it could be days and days and days of fishing before he would catch a fish, because his whole setup was oriented towards only the largest and best fish being able to even hit on his on his bait and on his setup. And so I realized that this is, so all of this really impressed upon me. The campaign trading is something you do all the time, but on occasion you really catch a big one, and that this is the goal. So having said that, first of all, I want to tell you that we have a special going. We have our Wyckoff market discussions every Wednesday, and we currently have a special going. We had a free webinar yesterday, and the next 3 sessions, which are the next 3 weeks, we're doing a 3 for $30 special. And if you go to the website, wyckoffanalytics.com, you can join our group and find out what we're all about. If you're at all interested in the Wyckoff method, please join us. And we have just a great time. We have a great community. Okay, so here we go. This is Dr. Pruden's adoption diffusion model, which we've talked about. I've talked about it in power charting. And the only thing I want to talk really about here is that this area is where bases are built, accumulation areas for very large moves upward. Campaign trading is about identifying the conclusion of accumulation, the beginning of an important markup, and then when you're campaigning, you're participating in the markup from the beginning to the conclusion. So early on here into the distribution area and participating, you might be adding to your position, but the goal is to stay on the trade throughout. And this is what we do when we campaign a stock. Swing traders would come in and out of the positions on the way up, which is a wonderful strategy. And I don't discourage that at all. It's just a different style. So come to power charting tomorrow. I talk more about campaign trading in tomorrow's episode, but I will talk about the schematics and how these are the areas where we build point and figure counts. And they're very important because that gives us an idea of how far up these campaign type stocks can go. So here, same thing. We have reaccumulation here, big counts. Oftentimes we don't see a campaign candidate until it's already been in its uptrend. So I've written a lot about campaign stocks in the blog, Wyckoff Power Charting, and I try to focus on those because they are, they're useful for swing trading and campaign trading. This was a stock that I wrote about back in 2016. This is a really nice, very large count in Micron Tech. This stock went up to $60. I consider a campaign stock one where you can identify with point and figure analysis a better than a 100% move. And the goal in campaign trading is to have multiple 100% moves over a long period of time. And so here we had a count line that was around $12 in a stock that went up over 60 at the conclusion of its advance. And so this is the goal here with campaigning. This is a stock that I wrote about, Albemarle. It's a chemical company, and I did analysis of the accumulation area, and then I did a big over the course of 2 blogs. I did a big analysis of the point and figure. So here you can see I put this point and figure in because I want you to see the model. Here are 2 segments. The first segment counted up to 91.86, and at the time that we did this analysis, it was at $66. And then the larger count went 110, 115. And so this isn't quite a 100% move, but pretty close. And this was a great campaign stock. And also you can see here that the counts could even be stretched out further. So there was definitely the potential for a more than a 100% move. Well, this is what actually happened. You can see this chart on the May 27th, 2017 blog, but Here's the base count. We just looked at these two counts here, and then a reaccumulation count that went 120, 125 from this area down here where we started our analysis, right in here. So we now have a count 120, 125 in this great campaign candidate. Well, this stock went up to 140 at the conclusion. And that often happens, is that they even exceed their point and figure counts. And so this is an example of what we're trying to do. And we were actually writing about this in the blog. A much more recent blog, which was a few blogs ago, was Wynn Resorts. And Wynn has this beautiful accumulation area that has formed from March back to October. And this has resolved into an uptrend. And this uptrend is now marking up out of the accumulation area. Looks very promising. And this is a cyclical advance. Now, I just want to show you, this is China large cap and Wynn superimposed on the same chart. And you can see the correlation is exceptionally good. Wynn tends to be more volatile. Look at these beautiful, this beautiful advance that took place in Wynn and China large cap. And then when one turned, the other turned, and they both went into cyclic declines into the end of 2018. And now they're both advancing again. And it could very well be that Wynn and FXI are campaign candidates, and they're acting quite well. The other thing that we look at in campaigning is we definitely want leadership. And earlier, Tom showed you some relative strength studies. These are very important to campaigning. And I'll show you some additional charts in a minute. But here is a turn in the relative strength of FXI to the S&P, where it's now in a leadership position. It's outperforming the S&P. And finally, here's Wynn point figure analysis. Here's the distribution. Look how well this worked. So this is the distribution area, 96 down to 78 with a midpoint of 87, went right into that zone. And then we were able to build a count. And so the count line's at around 112, counts 198, 218. And so we can see a markup is beginning, and we could actually make a bigger count in this chart later on. We tend to be conservative at first, conservative thresholds first, and then bigger counts later. So this counts potentially back to the highs. So as long as China can keep leading and Wynn keeps leading, this could be a wonderful campaign candidate. So another one is CF Industries. CF Industries has built a really nice count back in 2016-17 that goes to 74.5, 79.5. And then it just built a reaccumulation count that confirms the base count, which goes 78 to 81. And currently we can see that CF is around 45. Now, we know that some of these are just not going to work. As a matter of fact, a lot of them don't work. Another thing that's important is it's important to have the tailwind of the market at your back as the stocks are going up, because a strong stock market supports these campaign stocks. My tendency is, if I find a campaign stock, it's doing all the right things, irrespective of what the market is doing, I just want to get in there, be exposed to it, and then build a position as it starts to work. And so this is really important. And then also you want to have stops below these important levels. So here we have the bottom of the reaccumulation area. Have stops somewhere below this area so that if it does stop rising, and you can see it's rising now, and fails back below that area, you get stopped out, and then you keep an eye on it. It might come back and start to work again. Now, what I want to do, here's FMC. I'll just show you this. Current price is around 80, 81. Has a count to 111, 125 on this first segment right here. But notice there are two more segments. and these two segments generate much higher prices, and FMC is very close to its prior highs and appears to be completing reaccumulation. So this is very encouraging, and so this is definitely a campaign candidate. Now what I'm going to do is I'm going to go forward here, because we are going to talk about some of these stocks tomorrow in power charting, which you'll be able to watch on demand or watch 3 o'clock Eastern tomorrow. But here are just some of my favorites that don't get talked about in the show tomorrow. And I'm going to talk more about campaigning in the future. So here is Deere. And you can see that Deere has built a substantial accumulation area on this chart in the area of the 135 to 152 area. And this accumulation area counts up to 176, 168, which is right at the prior highs, and then up to 260, 268. And so this count right here is the initial count objective, and then this is the larger count objective. This looks like a campaign candidate. So have a look at that. Here's a vertical chart of Deere, just so you can see that it had just a really dramatic run up into the January 2018 highs, and then appears to be in reaccumulation ever since. It's become very dull and quiet right here at the end, and this whole area could be a very large count for a much bigger move. Oh, the other part I want to point out is relative strength. The relative strength has been correcting back to a rising moving average. It's in an uptrend right now. I would expect that when it comes back to a rising moving average, that it would want to then turn up, and probably conditional on the market, but turn up and start to rally again. Lululemon, this is a very interesting stock, and it has 3 sectors. Look at this. This is a 5-box reversal point and figure chart right here. So that's like comparable to, say, a monthly vertical chart. 5 boxes like a monthly, 3 boxes like a weekly, etc. And so you can see here that just the first segment of Lululemon goes up to 212, 233. Now, it could take years for these objectives to be met, but that's the hard part about campaigning stocks, is because you have to go through these periods of sideways action, big trading range where it just becomes volatile and trendless, and then you're in the stock. You just continue to hold it, and this is part of the art of campaigning, is that you got to go through the difficult times, because these good growth stocks will go down 30-40% in their consolidation periods, and they'll build new counts, and it shakes out all the shorter term traders. But if you buy right and you're in at good prices, you can weather that, even though it's just not any fun. But trend trading, that's the nature of it. It's part of the art of it, and we have to steel ourselves psychologically to be able to do this. So this stock, I think, is very interesting, because somewhere out in the future, it could fulfill all 3 of these segments and go to much higher prices than what we're seeing right here, potential to 212, 233. Okay, so let me go have a look at the Apple campaign completed. This is a campaign that we did real time in the blog, and we actually identified this accumulation area right in here, started to campaign Apple. We had these counts, and so you can see there's 2 blogs to go look at. There's the 2016 blog, which is this area right here, and then the 2019 blog, which, here we go, 3 years of campaigning this stock. Well, it finally did get to our counts and fulfilled them almost perfectly, and then showed weakness. I don't think this is necessarily a problem for Apple, but it wouldn't surprise me that Apple is range bound and needs a period of time to rest and build new count for a new move. I think it's too early to tell. We don't have a cause build for going up or a cause build for going down. And so last thing I want to show you is just some stocks that I've looked at And I'm just going to put the chart up. You can write the symbols down and study them for yourself. Here's a little gold company that I think is acting well in the gold space. Gold's not acting well right now, but it could turn at some point in the future. I think gold could be a campaign. Here, this is a case study. This is not necessarily a campaign stock right here. It's built account. This is Interactive Broker. It has built account that goes back above the highs. But look at this. Look at this beautiful. Look at this. This is a beautiful case study on how to campaign. And then look at it just get active. It goes into a reaccumulation. The reaccumulation confirms the accumulation. It throws over briefly and then goes into a cyclic decline. And this could be forming a new accumulation for a new move up. So great case study. Schwab, I think, is a very interesting potential campaign stock. And so it's got a base count, a conservative base count, 8180 to 7788, and then a larger count that goes up to 154, 170. And this is a stock that's right around $48 right now, or $45. So there is a great campaign theme. JBL, this is one that also I'm trying to campaign. You can see it's had a really good rally up to the resistance area, large count, relative strength is leading. Shake Shack, we've talked about that here in the past. Relative strength has now gone positive again. It's got a beautiful, very large accumulation area and has the potential to go much higher. This is a chemical, TPIC. It has an accumulation area, IPO, and now it's trying to build another reaccumulation for a potential move higher. Acacia Communications built a base. It's a little extended here, but it has relative strength leadership, which is all important. Altus, big base, jumping out, acting really well. It's got a counts high, much higher. So I'll leave you with that. Oh, and here's one that I talked about. Go back and when you see on Stock Charts TV, my point and figure workshop that I do, which is a two-part workshop, and they show it every so often. In the second part, I do a big analysis on Walt Disney and do this whole area, which is a huge count area. Look what's just happened. Now, I did this video back last summer, and since then it's continued to build a reaccumulation right here at the resistance area. Huge jump out, and now it's consolidating that jump. But I just think that means that Disney is just ready to start to become another campaign stock once again, as it was into 2015. And with that, I know I'm running out of time. I'll leave it at that, but we're going to talk more about this tomorrow in power charting and continue to talk about how we can identify campaign stocks and how we can emotionally prepare ourselves to get in these stocks and participate in them for a long time. So with that, Here we are.
Bruce, I got a question for you, and I'm going to give you some time to answer it, not now, but when we come back and we do the market update later, if you could take maybe 60 seconds and give me your thoughts on this one. I want you to look at the Dow Jones U.S. Toys Index, which is the $DJUSTY. It's one that I talked about on air a couple of days ago, and I was looking at it and I started thinking of it from a Wyckoff, an approach similar to yours. Where you're looking at whether is it accumulation, is it reaccumulation, is it distribution, redistribution? I mean, what's going on with it? But if you could take a look at that chart, and we'll probably be back to you in about 15 minutes or so. But if you could just share your thoughts with that, I would really appreciate it, because I was wondering from a Wyckoff approach whether or not this is something to be watching closely.
I'm on it. DJUSTY.
Yep, DJUSTY.
Got it.
$ in front. That would be awesome. And in the meantime, we're going to move into the 10 in 10. And I tell you what, we're running a little late, Erin, so maybe we just run right into the first stock.
Absolutely.
And you can kind of
We only had like 18 requests today, so lots of people paying attention to Bruce.
as you should.
I appreciate it.
All right, so let's go ahead. SGMO is going to be the first 10 and 10 symbol.
All right, I've gone through these biotechs before. I think you got to be careful with the biotechs. I mean, we were sideways consolidating throughout most of 2019. We finally broke down, and this is in a market that's been going straight higher. So look at the relative performance of biotechs. So any biotech I would be a little bit concerned with, and I would only be considering trading the best of the best. And I think when you look at this on a relative basis, we have not been able to get through multi-month relative highs on SGMO relative to the biotech. So I just don't think there's much to do. I mean, maybe you can watch the 50-day, see if we get a reversal there. I think we could go back and fill this gap, though, so I'd be careful here.
Okay. The most popular in the chat room is going to be Amazon.
All right, Amazon. Let's pull this one up. I've said before, I like Amazon. I think the pullback on light volume is not bad here. So annotation-wise, nice breakout. I'll put a couple of levels in here, but certainly that one makes a lot of sense. And then there was also this high back here in October that was cleared. And you can see that was tested over here quite a few times before we finally broke out. So that's the price support area that I'd be watching pretty closely. But I'm not sure we even get down to that, especially if the market were to rebound. I think Amazon's become a leader. We've started to see some nice volume trends here. I'd watch the 20-day moving average. I think, that's been holding now for the past couple of months. I wouldn't be surprised to see Amazon bounce right back off of that one.
All right. Let's see. You mentioned this one earlier in the program, Square.
Yeah, Square I meant to talk about earlier and didn't, so this would be a great time to do it. And I said recently, this is one I thought maybe we would get a surprise. And my thought process behind it, a positive surprise, not a negative surprise, but my thought process behind it was the fact that the financial administration stocks have been so strong. And if you go back and look at Square relative to its peers and the S&P, up until about 7 months ago, it's been very strong. And so I thought, okay, maybe it's just allowing its fundamentals to catch up with its price action. And maybe we were going to resume that move. Well, we didn't. Square lowered their guidance for the second quarter, and you can see the gap down there. So I think we got a couple things we need to consider before jumping into Square. I think that there are a couple levels, price support. You can see the lows back in January, and then also $70 acted as support for about 3 months on Square, and we appear to be going down below that. Heavy volume today, so I am looking to see where this thing closes. If we get a nice rally this afternoon, get back up near 70, I think we put in a bottom. If we don't, and we sit here and close with this big red candle, then I'm going to start to look for probably the next support level, which for me is down at 63. And if that one doesn't hold, I mean, I'm looking at Square moving back into the 50s. So other stocks within this space certainly are outperforming right now on a relative basis. Square is not. So unless you get that big reversal, I'd be careful with Square.
All righty. This Bud's for you. How about Budweiser, BUD, Anheuser-Busch, I should say.
All right. BUD. It's been in this uptrend, but let me just go down here and point out that when we're looking at the brewers relative to the S&P 500, they just set a 52-week high, or 52-week low, relative low. So when I see a group that is performing so poorly like that, if I'm going to trade a stock within the group, I am going to keep a very tight stop. We have been trading above this 20-day moving average for the most part over the past couple of months. I think if we went back down below that recent low from a week ago, so I'll just draw a line right across there. I think if we go back down below this low, I'd be out. I would not take any chance. I don't want the stock rolling back over because it is in a very weak group on a relative basis. So I don't know. I'm not really seeing a whole lot I like here. I personally would stay away, but if I did get in, I would just keep a tight stop.
All righty, let's see. How about Neptune Technologies, a pharmaceutical company, NEPT?
All right. Well, the pharmas, you can see just kind of going sideways. I think I drew this the other day. It looks like lower highs, higher lows, maybe a squeezing symmetrical triangle. This is a stock that's been performing pretty well relative to the group. So if we get a breakout to the upside, I think that would bode well for the stock. But there are two levels that I would watch closely here. I think the rising 20-day moving average, because we are in an uptrend, I think that is one thing to watch. And the other is that price breakout that we saw right here at about 385. Well, the two coincide with one another. So as long as the stock stays above about 385, I'd be okay with it. And for now, I would just hold.
All right. Next one up is CareDx, a healthcare provider, CDNA.
All right, CDNA. Yeah, I think when you said healthcare provider, that pretty much sums it up. I think that that's the big problem here. And until we get that reversal on the relative performance of the group relative to the S&P 500, I think it's just really difficult. I mean, it looks like it's starting to roll back over again on a relative basis, and it has been a terrible 2019. This was a group that was one of my favorites at the end of 2018. But once you start to break down and you show a new relative low, a bounce, and then another relative low, that starts to paint a completely different picture. So I think this is a stock that until its group begins to strengthen and until it can clearly and definitively break back up above this 20-day moving average that it keeps testing, I am not going to be a fan. So I would pass on it for now.
All righty. Let's see here. Next up is FLIR Systems, FLIR. Our only industrial request.
All right, FLIR. False breakout right there. Also pretty important gap resistance. Let's see. It is in the defense group, which has been strengthening over the last month. This is a group I'm watching pretty closely. I'm not saying, saying things are just great just yet. But if FLIR could break out relative to the group, and then the group could break out relative to the S&P, that would be certainly the daily double. Got to use a little horse racing analogy there, given that we got the Kentucky Derby coming up. But yeah, right there, I think those are two lines that I would watch real closely on this stock. And then, of course, price action. You've got gap resistance there. Looked like we were making the breakout. We could even draw another line up at that intraday high. We went through that one and then came back down. I think that you've got a couple of, I think in the short term, I would watch this area 51 to 51 and a half to the downside, top side 53 to 53 and a half. Let's see which way we break out of the short term range. And at the same time, let's follow these relative strength charts. I think that'll give us some clues going forward.
All right, let's see. How about a bond ETF, the 7-10-year Treasury bond, IEF?
Yeah, I can do this on a regular chart here. I think as long as we hold those recent lows, there was a breakout, provided some, that prior resistance provided support. You can see right here. So there was a top, and you can maybe even do another one here because that was a pretty big top where we consolidated for quite some time. But this is an area I'd watch to the downside. Recent highs, I'd watch the upside. I just think we're in a pretty narrow trading range right now, sitting almost in the middle of it. I don't have any, major thoughts on this one other than it's just in a trading range sideways. So I'm not a big trader of bond ETFs because I look for quick moves off of key support. And this is not going to make any kind of big move. So I personally don't trade it. But if I was looking at it to trade, I'd watch this trading range for now.
Okay, let's see. How about comm services, Discovery, Disca?
Yeah, they just reported earnings, gapped up earlier today, but you can see coming back down after that. And this is another one I think on a relative chart I just probably wouldn't trust, because you can see the broadcasting group breaking out. Of course, a lot of this is because of Disney. But look at Disca on a relative basis versus the group. I mean, that's just not good. So you get this gap up, but it doesn't last. And there's the annotation there versus the group. Of course, the group's been strong, has been getting stronger here on the breakout. But this just isn't one of the better stocks within the group. I actually like Disney a lot more, and there are probably some others in that group that I would pick before this one. But I think the fact that we gap up and can't hold it, move back down, maybe a price support level to watch if you're in it is right there. You can see the last couple of pullbacks have held at about 28.60 or so. Today's low, 28.84. I think if we close below, let's give it a little bit of room, 28.50, I'd be very concerned here. So I personally would avoid it.
All righty, last one, Cypress Semiconductor, CY.
All right, I like the semis, and Cypress certainly has been building to the upside on a relative basis, just kind of going along for the ride, mostly sideways, although we have seen some relative strength here over the past week or two. But the overall group relative to the S&P, I think, still remains strong. Despite the drop, despite Xilinx disappointing, Intel, maybe some others, I still think this is a group that you want to at least have some representation or be looking at. Overhead resistance is going to come in shortly on Cypress, so we want to kind of keep an eye on that. That would just suggest to me that if I get a little bit more strength, I might want to take profits in the near term. But I like the volume trends. I like the way it's been trending higher. I think it eventually breaks out and makes a new high. But again, as a short-term trader, I'd respect that resistance at about 1775.
All righty, that does conclude the 10 in 10. Here are the symbols that we just went over. I will have these up in the Market Watchers Live chart list. All you have to do to go and see that is to go to the blogs articles tab, click on that, click on the Market Watchers Live blog, and the link to that chart list is right there at the top. All right, it is time for our final market update. Let's see what has been going on in the markets while we've been having so much fun. All right, here we go. Down day, obviously, not the best day we've had in a while. Right now, we're seeing that the Dow is down over 224 points. That's 0.86%. S&P 500 is down 0.59%. This is a daily chart, two-minute chart, just so you're familiar. And then also we have the NASDAQ. It is also leading to the downside with 0.65% decline. New York Stock Exchange not having any better of a day, although it looks like the move to the upside here in the last hour was a bit more strong than the other indexes we've seen. Russell 2000 actually has made it back up into positive territory, but is now back down below yesterday's close. We can see that Canadian markets are declining alongside the U.S. markets. Treasury yields are higher right now at 2.552%. VIX is rising. Excuse me. We had 16 as a high today. Fell back down, but we're still getting a reading of 1535 on that VIX. UUP is up on the day, almost 0.25%. GLD also on the, actually GLD is down 41 cents right now at 119.99. USO is down 3.63% right now, currently at 12.74. TLT is lower on the day as well at 123.13. As far as our sectors go, it looks as though real estate and financials are going to be in the lead. Utilities are unchanged. Everything else is down, with energy, the big loser right now, down 1.34%. And that's all I have for the final market update. Going to pass it back to you, Tom.
All right, and I'm going to do this as a precursor to having Bruce come back on and talk a little bit about toys. But here's a one-year chart on the toys index, and we had this huge decline in the fourth quarter. Of course, we know the market's made its way back. Toys have not. Toys have really struggled. They literally have been toying with this 840, 850 level, trying to get back up. But I've noticed the volume picking up here in the last week. So I mentioned a couple of days ago, I wanted to have Bruce comment on this one. And we saw the huge gap down back in February, but we held the prior low. So we were able to absorb all of that selling and start to move up on good volume. So I'm going to turn it over to you, Bruce. But if toys are able to make that breakout above 850, do you see this as a positive formation and pattern under Wyckoff?
Yes, and it has a lot to like. We have a long cyclic decline, climactic volume at the beginning of December into right there, and then testing that at the lows, more climax. Lots of supply present. all this volume surge in February, I would imagine, is related to probably an earnings report. I know this is a small group with only a few stocks in it, but what I really like is the higher lows from late December on. Now, having said that, and being up against the resistance area, look at yesterday's volume. So a very high volume day, very, very narrow range price bar at the top at the resistance area. And notice the bar that preceded it, that bar has a big tail. And so I believe that there is supply present up here, and that this is probably a sign that U.S. toys index is going to attempt to come back down, maybe to the long-term moving average. The less it moves back, the better. The thing that we really want to see, the bullish thing, is to see it jump the resistance area and then pause there without coming back into the accumulation structure. Or the second most positive thing would be to see it just drift back down towards the moving average right from here, where it's dull and quiet, narrow ranges, volume dries up as it pulls back. But I do see that there's some selling at the top of this area. Now, having said that, Tom, you may want to put up a weekly chart, just because I'm going to just do a couple of point figure counts. I was pounding away on point figure counts while you're doing 10 of 10. So there's an initial count there that goes back to that big wide swinging bar at the beginning of February. So we count across from where we are now to there. That count goes from the low at 710, that counts up to 965, which, look, it takes us right to that longer term moving average. Just a classic place to go. So there's a segmented point and figure count to 965. Then if we take the whole shebang, we take the whole count all the way across, we get a count from 710 plus generating 675 points in the accumulation area for a count of 1385, which is a new high. So probably need a good bull run in the market, which we could get, out here. The thing about point figures, it can give you an idea where it can go. It can't tell you when it's going to get there. And so it could be that maybe by the end of the year, I suspect that we'll see more rally attempts in the market, maybe new highs as 2019 goes on. That could produce the opportunity to get this up to 1385. But first stop, 965.
So the inability for toys to outperform, I mean, obviously this has been a group that continues to underperform because we've seen the major indices rally back to all-time highs, and you can see toys still just stumbling down here near the bottom of this chart. So the fact that there's a relative weakness here, you still believe if we get this breakout and we get a little volume coming in, that could still be the signal that all of this distribution and all this supply has taken place and is behind us, and we could be ready to roll.
That's the funny thing about even campaign trading, is that stocks will become really doggedly poor, especially during reaccumulation. They'll just look so much worse than the market while they're being reaccumulated by strong hands. And then all of a sudden they just come to life and become leadership. That probably needs to be the case with the toy index. This is not a place right here to initiate trades, because it's right at resistance, and you can see that there's supply present at this resistance area. But given an opportunity to pull back and not be able to pull back very much and on light volume would be hugely bullish, I think. Or doing it from a jump out of the accumulation area and then backing up, old resistance becomes new support. And so either of those scenarios, I think, is bullish. But stocks will often be dogs and laggards as they're being accumulated into the conclusion of the accumulation area. And then all of a sudden they just emerge into this beautiful leadership position and they just start taking off. And when that happens, that's like what happened with Disney.
Yeah.
Disney did that, and all of a sudden, boom, it's up and out, and it's just huge leadership.
Yep.
And so this happens often.
Yeah, Qualcomm, same thing.
And you know, the poor underperformance and the relative being a relative strength laggard while it's being accumulated actually discourages traders from participating in it. And the whole time the big CO types are building huge positions, and they use that laggard nature to discourage others from coming into the space until they're done building their positions.
All right, cool. Well, I appreciate you taking a look at that and coming back. That was awesome.
Mm-hmm.
All right, we are going to move into our final segment, which is we're going to take a look at relative strength in the industrial area. So Erin, Bruce has agreed to do this as well with us. And so Erin, Bruce, and I will just take a few minutes each and go through some things that we like, don't like about industrials. And then we're going to give you a conclusion. If you looked at your poll, the poll that's up today, we listed the 6 top performing industry groups within the industrials year to date. And we asked you to give us the one that you believe is least likely to continue to lead. And we're going to finish off our segments by giving you our pick as to which one we would not trust as we go forward. So, Erin, I'm going to let you go ahead and start. What do you have on industrials?
Well, you guys talk toys. I'm just going to quickly show you mine. Ascending triangle count would take you and close that gap and bring you all the way up to this overhead resistance just above 1,000. So I like it.
Love it.
All right, but let's get on to what we were actually going to look at. All right, so I put all of these industry groups on my candle glance just to give me a little bit of a feel for which ones I might not like. And really, I think it was pretty obvious, the ones that aren't looking too good. And that would certainly be the industrial machinery, and in this case, the business support services. But I actually ended up picking the industrial machinery one. I just thought this one looked a little bit more negative than the others, and it really has made a pretty big run. So I think that it has more room to pull back a little bit. Plus, I just didn't like the setup on it. And, here's my reasoning. Okay, first of all, I think you could make a case for a possible short-term head and shoulders with the neckline rising here a little bit. But the other problems I have are the PMO has been in decline. And notice, even when we made that big move to the upside here to try and close and did close that original gap, the PMO was really pretty much unimpressed. And now it is moving, it's accelerating lower. And some might point to, but the OBV looks pretty good. You've got these rising tops. Actually, I find this to be very bearish. I look at this as a reverse divergence. It's a lot clearer in the thumbnail, but you can see the price top here and the price top back here. And what are the corresponding OBV tops? Look at the big rise on the OBV here. Yet, price was not able to push to a new high. And to me, that's a reverse divergence. It tells me that there's weakness there. And we did get the drop today. So I don't like that one pretty much at all. And then, like I said, business support services I thought was looking negative as far as the PMO on the candle glance. And we are seeing a little bit of a breakdown here today, but well above the 20, OBV rising nicely within that. Sure, we've got the PMO falling, obviously, and gave us a sell signal on the way up. So that's why I think this is still going to be a problem for business support services. And I can just whip through these really quick so I can give everybody some time. But there's the other one, railroads, I thought didn't look good. Notice OBV is flat. And we're seeing declining tops here on price. Again, sort of a negative or reverse divergence going on, and momentum dying. We looked at that one. Aerospace, rising wedge, and we do have the PMO topping, but I thought that industrial machinery looked worse, and building materials, here we are. It looks like a rising wedge, honestly, and but it still looks pretty good. You notice the PMO turn back up. OBV is in line, and it's making all-time highs. And that's me. So I'm industrial machinery. Don't like it.
All right. So we got one in the books. Bruce, what do you think?
Okay. Well, let's see. Let me
Yep. Feel free to share whatever you've got.
Okay, so here's building materials, and this one, I love the way that it rallied off the December lows, and it's had a after being very weak into the end of the year, it's had a really good relative strength advance. It's not at its prior old highs. That may result in building materials needing a pause and resting here. But I think that there's reasons to think that's promising. The let's see, MT. This is interesting because, and this is the marine transport. Look at this big accumulation area. This looks really promising to me. Now, it had a good jump up and out, but when it declined into the end of December, it came back into the structure, which is okay. It can do that. Since then, it's had good relative strength as it's ran up. You can see the relative strength is on a buy here. So this is really encouraging. So I like marine transport. The one that I'm going to choose as one that I think is maybe troublesome, and this may surprise people, is aerospace. And I look at aerospace and I see a really good move at the end of 2018, which ends in February, early in this rally. And then we have a breakdown to the moving average and a rally of poor quality. Look at the nature of this advance. The advance is slow and halting, has narrow range bars here towards the end. And I see it up against prior resistance areas, which this is an upthrust right here. And so I would be bracing myself for an attempt to go back to the moving average. And if it goes down any further from there, I think this might be an upthrust after distribution. And so this is my vote for the industry group that I think maybe has the most vulnerability. And then the only other one I wanted to show you, and then I will get out of the way, is railroads have been really good, but look at U.S. commercial vehicles. This looks really interesting to me. It's had a good run up in 2019. This looks like it might have elements of reaccumulation in it. May need more work, but beautiful uptrend here, consolidating, reaccumulation potential for another move up. So I'm looking at this as maybe having some long-term potential for another move higher. So I'll leave it at that. Did I do my job?
You did your job. You did
okay.
Your job. And so, I am surprised that you went with aerospace. So you're right.
Yeah, it was actually on my list of troublemakers too.
Well, the way that it lost its mo in 2019 and had that big break.
Yes.
And then the nature of the rally that came after that just has me concerned that it may be vulnerable.
Yep. Well, that's what we're looking for. So
yeah.
Perfect. Okay, I will go through mine. I'm going to start first with a couple of areas I think still look pretty strong. And the way I was evaluating this on a relative strength basis, I think sometimes when you look at the PPO of the relative strength, it's kind of like looking at the RRG because you're comparing it to the benchmark. So here, this is the momentum not of the railroad group, but it's the momentum of the railroad group relative to the S&P 500. And this is the line that shows you the relative strength. So when I look at railroads, I see no problems whatsoever. As long as that PPO remains above zero and this trend remains intact, I really like the railroads. I've liked them all throughout 2019, and they really never even took much of a tumble on a relative basis, even back in the fourth quarter when the market was weak. So I think railroads remain very strong, and this was the leader in 2019, and I suspect we've got more upside on this one. The next one that I wanted to look at was business support services. Just recently broke out to a new relative high, and look at the PPO strengthening. Very difficult for me to predict that this is going to be going down anytime soon. Third one up is the defense group. Now, this was not one of the choices, because it hasn't been a great performer. But I wanted to just mention, I think defense stocks are really beginning to gain some momentum. Now, we went through the declining 20-day moving average twice before, only to fail. We're just back up above it again, so it's possible we fail. But this time, instead of failing and going to a new low, we failed and went back down and just put in a double bottom. I think if we can take out this recent relative high, I think you're going to start to see more and more money rotate toward defense. So this is one of my favorite groups within the industrial area. Hasn't been a great performer so far, but I think we're starting to see some earnings reports, some signs of some strength there. Fourth one I wanted to show. This is commercial vehicles and trucks. I see a potential bottoming relative reverse head and shoulder. So you can see the left shoulder, neckline, head, right side of the neckline, right shoulder. I think if we can break back up above that, you can see right now the relative PPO is literally sitting on the center line, waiting for something, either a breakdown or a breakout to the upside. I'd watch this one pretty closely. The last one I have before I give you my pick, this was one that I was concerned about, building materials and fixtures, only because look how long the PPO has been below the center line. And look at that relative downtrend. But I like what's been happening here recently with the uptrend now in play and moving back above the center line. So at least in the short term, I'm going to give this one a pass. I'm going to say that maybe things have turned here. I'm not going to pick the building materials and fixtures, but the one I am going to build, and I didn't annotate this one yet, but the one I am going to pick is going to be marine transportation. And I know, I got to get another letter in here. I know you didn't like this one, Bruce. You wouldn't like my pick because you did like the group, but I think this is the one that on a longer term basis, I don't know. I just don't trust it. When you see these moves up, then it comes right back with relative underperformance. We've seen this multiple times over the past few years. I agree we are starting to see some nice strength here, but we've yet to take the PPO back through the center line. So I'm going to go with marine transportation as the one that I least trust over the balance of 2019. So we all went different. We can pull up the summary.
Yes.
And we all had reasons for, and that's what looking at the market and technical analysis is all about. We all had different opinions. And now we see what the audience thought. What do our think? Wow. Okay. That means I'm wrong. Probably.
I know, right? They actually agreed with you. No, you get a lot of agreement out there. I'm the one who usually is the dark horse.
Well, and I would say that Bruce was correct in his assessment of aerospace, that not too many folks would maybe agree. Only 10% did.
Mm-hmm.
I don't know. I think we have a pretty smart group here, so I'm feeling lonely.
Well, I didn't like it either. It just didn't look as bad as industrial machinery to me.
By the way, I have a blog that I did a couple of weeks ago where I compared railroad industry group to trucking. And do have a look at trucking because it looks pretty bad. And maybe a sign of the economy softening.
Yeah, we definitely will. We got about 20 seconds to go here. So I do want to just say that we are seeing a little bit of rebound in the market. We've got the Dow Jones Industrials currently down 157 points. NASDAQ down only 22. And the Russell 2000, which has shown a little bit of relative strength of late, is actually up 3 points today. So we are, got some mixture there. But thanks again, Bruce, for stopping by. Certainly appreciate having you.
Always a blast to be with you guys.
Thank you.
So much fun. Let's go fishing.
There you go. I do want to thank all of you for being with us today as well. Please remember to complete the survey as you exit. It's located below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow. Happy trading.